Operational effectiveness. Los. Define operational effectiveness, efficiency, quality, excellence, innovation, and customer responsiveness, and discuss how each impacts differentiation and competitive advantage. Operational effectiveness refers to performing similar activities better than competitors, while efficiency focuses on achieving maximum output with minimum input. Efficient processes reduce waste, lower costs, and improve productivity. When a company consistently operates more effectively than rivals, it can pursue cost leadership or reinvest savings into innovation and marketing. Although operational effectiveness alone may not guarantee sustainable advantage, since best practices can be imitated, it strengthens short to medium-term competitiveness and supports superior financial performance. Quality and excellence relate to delivering products or services that consistently meet or exceed customer expectations. High quality reduces defects, warranty costs, and reputational risk, while excellence reflects a broader commitment to superior standards across operations. Organizations recognized for reliability and performance often build strong brand loyalty and customer trust. This differentiation reduces price sensitivity and enhances long-term profitability, as customers are willing to pay premiums for dependable and reputable offerings. Innovation involves developing new products, services, processes, or business models that create unique value. Innovative firms anticipate market needs and respond proactively to technological change. Successful innovation can generate first-mover advantages, intellectual property protection, and higher margins. It also enables adaptation during industry disruption. Continuous innovation fosters differentiation by offering distinctive features or solutions that competitors cannot easily replicate. Customer responsiveness reflects the ability to understand and meet customer needs quickly and effectively. This includes customization, after-sales service, and prompt issue resolution. Highly responsive firms build strong relationships and enhance customer satisfaction. Responsiveness strengthens differentiation by improving perceived value and loyalty. When combined with operational effectiveness and innovation, it creates a comprehensive competitive advantage that is difficult for rivals to imitate. Financing strategy. Los. Explain how an organization's financing strategy and financing capacity impact competitive strength and strategic initiatives. An organization's financing strategy, including its mix of debt and equity, dividend policy, and capital allocation priorities, directly influences its strategic flexibility. Firms with conservative leverage and strong cash flow generation possess greater capacity to invest in research and development, acquisitions, market expansion, or technology upgrades. In contrast, highly leveraged firms may face constraints due to debt covenants, interest obligations, or limited borrowing capacity, restricting strategic initiatives and reducing competitiveness. Financing capacity determines whether the organization can pursue growth opportunities or withstand economic downturns. Strong liquidity, stable cash flows, and access to capital markets enhance resilience and enable rapid response to competitive threats. Limited financing capacity may force firms to delay investments, reduce innovation spending, or divest assets, weakening long-term strategic positioning relative to better capitalized rivals. Financing decisions also affect risk profile and cost of capital, which influence competitive advantage. Excessive debt increases financial risk and earnings volatility, potentially raising the cost of capital. A well-balanced capital structure lowers financing costs, supports sustainable growth, and enhances investor confidence. Thus, financing strategy is a core strategic consideration rather than merely a financial decision. Los. Evaluate a given organization's financing capacity and financing strategy. Evaluating financing capacity requires analyzing liquidity, leverage, profitability, and cash flow metrics. Key indicators include current and quick ratios, debt-to-equity ratio, interest coverage ratio, operating cash flow, and free cash flow. Strong liquidity and consistent cash generation suggest the ability to fund investments internally or service additional debt. High leverage combined with weak coverage ratio signals constrained capacity and heightened financial risk. Assessment should also consider capital market access, credit ratings, and historical financing patterns. Companies with strong reputations and stable earnings may raise funds more easily and at lower cost. Dividend payout ratios and retained earnings policies indicate whether management prioritizes reinvestment or shareholder distributions. Comparing financing metrics to industry benchmarks enhances interpretation and highlights relative financial strength. A comprehensive evaluation links financing strategy to strategic objectives and competitive context. For example, aggressive expansion strategies require sufficient borrowing capacity and risk tolerance. Conservative financing may limit growth but enhance stability during downturns. The goal is to determine whether the organization's financing structure supports long-term strategy or creates constraints that weaken competitive positioning. Internal analysis synthesis. Csca. Apply SWOT analysis, gap analysis, and situational analysis to a given scenario. Applying SWOT analysis requires identifying internal strengths and weaknesses alongside external opportunities and threats within a scenario. Strengths may include financial stability, brand equity, or technological expertise, while weaknesses may involve high-cost structures or limited innovation capability. Opportunities could stem from favorable industry growth or regulatory changes, whereas threats may arise from competitive rivalry or substitute products. Effective application links internal capabilities to external conditions to generate strategic implications rather than merely listing factors. Gap analysis compares the organization's current performance or capabilities with desired strategic objectives. The analyst evaluates revenue targets, market share goals, profitability benchmarks, or operational efficiency standards and identifies shortfalls. Once performance gaps are recognized, management can determine whether they stem from resource limitations, structural inefficiencies, or misaligned strategy. This approach supports prioritization of initiatives needed to close performance gaps. Situational analysis integrates both internal and external assessments to provide a comprehensive view of the organization's strategic position. It evaluates competitive forces, macro-environmental trends, financial capacity, and operational effectiveness. When applied properly, situational analysis highlights alignment, or misalignment, between resources and market conditions, guiding actionable recommendations that strengthen competitive advantage and reduce strategic risk. Csca. Synthesize information and prepare an internal analysis. Preparing an internal analysis requires integrating data on resources, capabilities, financial performance, value chain activities, culture, structure, and incentives. The analyst must identify core competencies and assess whether they meet criteria for sustainable competitive advantage. Financial ratio interpretation, cost structure analysis, and cash flow evaluation provide insight into organizational strength and flexibility. The objective is to determine how internal factors support or constrain strategic objectives. Value chain analysis should identify activities that create value, cost drivers, strengths, and weaknesses across primary and support functions. Benchmarking against competitors reveals relative efficiency and differentiation capabilities. Linkages among activities and potential synergies across business units should also be evaluated to determine whether economies of scope or operational improvements are achievable. The synthesis must assess organizational alignment, including whether culture, structure, and incentive systems reinforce strategic priorities. Misalignment may limit execution effectiveness even when strong resources exist. A comprehensive internal analysis concludes with identification of critical strengths to leverage, weaknesses to address, and capability gaps requiring investment. Ultimately, the internal analysis should provide clear strategic implications, linking findings to competitive positioning and risk exposure. Rather than summarizing isolated facts, the analyst integrates qualitative and quantitative insights into a cohesive assessment that informs strategic planning and long-term value creation.